Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris Rapeseed, Winnipeg Canola, and Malaysian palm oil.
Paris Rapeseed. Now, the market's high in January, whilst making newer higher highs, had some issues. The closes were the ones to watch, and they all closed as they had in late November last year, below the March 23 high at 540 3/4. All this action turned out to be a triple top, with January itself being a horn top. 7 weeks ago, prices were once again held up by the medium moving average, currently at 508 1/4. But with changeover, we had a big gapping move lower. Originally, the gap was 490 even down to up to 509 3/4. This is not the largest gap lower that I've seen here in this market, but it was useful enough such that prices opened after it below the long moving average, currently 494 1/4, and below two important supports. The significant February 2024 today uptrend, since adjusted lower, and that's currently at 451 1/2, and the neckline extension, currently 487 even, of the April to August 2024 head and shoulders top, plus just above the bright green neckline extension of the August to September 2024 reverse head and shoulders bottom, currently at 479 even. After this, prices started to recover upwards and tried to fill in the large gap overhead, which they very nearly did. But despite moving up over the gold long moving average, the market over late February stalled and ended up forming a small double top and what turned out to be a larger mid-January to mid-March bearish halfway hesitation, dropping down 2 weeks ago, down through the primary and secondary targets of both the small double top, and this week reaching the target zone below for the bearish halfway hesitation. Now, for the earlier triple top idea, I said 3 weeks ago, and I quote, "This pattern, though not a very pretty one, does give us some potential targets below of a primary target down at 480 even, and a secondary harder to reach target X1 down at 458 even." Now, the move lower 3 weeks ago down to 481 3/4 had just about reached the primary target zone down at 480 even, enough for me to consider it reached, end of quote. I can add to this that last week prices continued to move lower, reaching the secondary target X1 at 458. This week we tried even lower on Monday, but after forming a hammer pattern on that day, on Monday, a pattern traditionally seen as a bullish reversal pattern, we have seen a swift and somewhat remarkable recovery, such that we already encompass all of last week's action. Now, this sets up the opportunity for a lesser outside week pattern, but not for a weekly key reversal. For that, we are in the unusual situation of requiring a close this coming Friday well outside last week's range. We would need a close on Friday over 478 1/4, and as this is so close to the bright green neckline extension overhead, I would add, ideally, I'd like to see a close over the bright green neckline extension, which is currently at 479 even. Now, is this doable? The answer is yes. But the congestion we've seen in the past as prices approach from below the 470 even area overhead, and here I'm referring to what we saw in August and September last year, well, it does raise a question mark as to whether the market can fulfill the obligation for such a weekly pattern in basically 1 and a bit days. Winnipeg Canola. The market started, for the most part, a 3 steps up and 2 steps down action, gradually moving higher from November last year till earlier this month. This overall action higher left us with an important bright green December 24 to early March 25 ascending wedge pattern. 3 Fridays ago, the market closed below the lower trend line for the first time and started the resultant move lower from this pattern, accelerating the fall with a gapping changeover between 634 down to 615, which remains still open. For this move down, I laid out a primary target at 626 on a downside, which was easily reached, and as I said 2 weeks ago, and I quote, leaving a secondary harder to reach target X down at 578. and a tertiary target X1, an even harder to reach target down at 564.5. End of quote. By the middle of last week, the market reached the secondary target X at 578, and by the end of last week, it had reached the tertiary target X1 at 564.5. Prices have since then recovered, but nowhere as high as they have seen elsewhere in other markets. There is no weekly key reversal or even the lesser outside week opportunity here, not yet. As overhead, we have the 50% absolute Fibonacci line at 606.90, and this might well put off any further significant attempts higher. Finally, there is the imperfect bow tie crossover, which I've spoken about for weeks now, made up from the short medium moving average, currently 637.60, the medium moving average, currently 631 even, and the long moving average, currently 625.90. The moving averages went in and came out in the right order with a bullish incentive, but the issue is that it was not a completely clean altogether crossover. However, even with that being said, it was worth bearing in mind, as I said for weeks now, and I quote, that such a pattern would have about 15 to 20 sessions after crossover, one or more of the following: a new trend developing, an old trend being reinforced, and or volatility. The time period for this is between the 11th and the 18th of March, end of quote. Last week we were right in the thick of it, and as I said in my video commentary last week, and I'll just echo it this week, and I quote, at the least you can say we have seen volatility this week. Bursa Malaysia crude palm oil. I said here 23 weeks ago, and I quote, of all the oilseeds and veg oils, palm oil has been the toughest to decipher in recent days. There's been a lot of activity, and the changeover gaps, most notably in mid-September, have been a great hindrance. However, there have been 2, possibly 3 patterns here that have influenced the market and seem to have captured it somewhat, at least since April. So that's April last year. End of quote. Okay, so things have developed since then, but a good place to start is looking at those patterns highlighted so many weeks ago. The first of these patterns is the bright red neckline, currently 44.51, of the September to November 23 reverse head and shoulders pattern, which I've highlighted repeatedly, which even 2 weeks ago, as well as this week, supported the market. Additionally, and this is one I also added a few weeks ago and many times previously, is the dark blue neckline, currently 44.74 of September 2015 to November 2017 head and shoulders top. I have not been sure about this one in the past, but as it is an old one, a super old one, they've been way below the current market, but similarly to the bright red neckline, had 2 weeks ago, even this week significantly supported the market. I'll continue to bear both of these in mind. The third pattern here is the very slowly rising long moving average, currently at 43.58, that stopped the market falls, stopped it dead in mid-January, and has truly acted as a base for the recent rise in prices between January and February. Now, there are other newer and closer to the market features to watch out for, and to start with, I'd look to how the market has dipped into a wide congestion zone between 44.08 to 45.59 below the market, and then waded back upwards. Within this congestion zone, we have the old March 2008 previous all-time high at 44.84, as well as the April 24 high at 45.27 and the June 22 low at 45.59. This congestion zone helped hold up prices 2 weeks ago and this week as well. Next, 5 weeks ago I outlined the mid-August 24 to mid-January 25 bullish Andrews pitchfork, which I last week discussed finessing the pattern into a shallower bright green bullish shift pitchfork for the same move on my daily chart. Well, this week I have done so, and right now we are not too far above the lower tine, currently at 44.08. Next, a new pattern has possibly emerged over the last few weeks, and this is very much dependent on 2 things. Firstly, this is something I see on my daily continuous chart. So if you disagree with daily continuous charts, well, you won't like this or what I say about it. And secondly, the last 4 weeks' actions have helped draw this possible pattern, and it would not have existed without those actions. Though in truth, I think this pattern is either morphing into yet another pattern or developing into a wider but still same pattern. It is a 2025 based possible reverse head and shoulders pattern, with a possible purple highlighted neckline, currently at 49.36. This is where it became a little tricky, as I had questions over this second shoulder for such a pattern, where it should be. Last week I said, and I quote, it is a narrow mid-February based action, or it is a wider late February to date based pattern that is still forming. Well, end of quote. Well, since last week, the second shoulder issue has clarified and is a narrow February based action, though this still leaves the question open on whether it is a delayed reverse head and shoulders bottoming pattern or a reverse head and shoulders continuation pattern. It still leaves that question somewhat open. Finally, last week I drew a mid-January to early March nascent bullish Andrews pitchfork. I added, and I quote, "I am prepared to finesse this into a shallower bullish shift pitchfork or retire it completely if it is no longer functional," end of quote. Today, this pattern and the bullish shift version are no longer functional, and I have retired them completely.
Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.